Let me guess. You've looked at your savings account, maybe your investment account, and thought, if I could just get to $250,000 invested, I'd finally feel safe. Like that number sounds big, right? $250,000. It feels like something serious people have, responsible people, financially stable people. But here's the uncomfortable question nobody really answers clearly. What does $250,000 actually pay you per year? Not in theory, not in some motivational Instagram quote, not in a just invest and you'll be rich way. I mean real numbers, real income, real life. Because here's the thing, a lot of people chase the number without understanding what the number actually does, and that's where people get blindsided. My name is Leonard, and I spend way too much time thinking about the what $250,000 in investments actually pays you per year, investing. If you're someone who's grinding hard, saving consistently, trying to build wealth, but secretly wondering if it will actually change your life, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Look, today we're breaking this down properly. We're going to do the math, talk about realistic returns, factor in inflation, address the psychological trap most people fall into, and most importantly, figure out what $250,000 actually means for your life. Because here's what most people don't realize. The number isn't the goal. The income is. Part 1. The fantasy versus the math. When people hear $250,000 invested, they imagine passive income freedom, no boss, no stress, beach somewhere. But let's do the math. Historically, the S&P 500 has returned around 10% per year before inflation over the long term, according to data from Standard & Poor's going back nearly 100 years. After inflation, that number drops closer to 7% real returns. So let's use both. Scenario 1, 10% return, pre-inflation. $250,000 times 10% equals $25,000 per year. Sounds great. But here's the thing. Markets do not pay you a stable 10% every year. Some years plus 20%, other years minus 15%. Some years flat. If you withdraw 10% annually, you're almost guaranteed to run into trouble in down years, which brings us to something critical. Part 2, the 4% rule. Financial planners often reference something called the 4% rule, based on research from the Trinity study. The idea is simple. If you withdraw 4% per year from a diversified portfolio, your money has historically lasted about 30 years. So let's apply that. $250,000 times 4% equals $10,000 per year. That's about $833 a month. Pause. Let that sink in. $250,000 invested responsibly might generate around $10,000 per year sustainably. Not $25,000, not financial freedom, not retirement at 35. Now, you might be thinking, wait, Leonard, that's depressing. I know, but this is where it gets really interesting. Part 3. Why it feels like it should be more. Psychologically, our brains treat $250,000 like a jackpot number, because to earn $250,000 at a job, that's a huge salary. But invested capital doesn't behave like earned income. Think of it like farmland. If you own land worth $250,000, you don't harvest $250,000 in crops every year. You harvest a percentage. And if you overharvest, you destroy the land. That's exactly what happens when people try to withdraw too much from investments. The number feels large. The income it produces is smaller than expected. That gap between expectation and reality is where most financial disappointment lives. Part 4. The power of compounding instead. Now here's where most people make a critical mistake. They focus on what $250,000 pays them today instead of what it becomes if left alone. Let's assume a 7% annual average return after inflation. If you leave $250,000 untouched for 10 years, future value equals $250,000 times 1.07 to the 10th power, equals roughly $491,000. In 20 years, approximately $967,000. Now we're talking. This is where it gets really interesting. The income at 4% on $967,000, that's nearly $38,000 per year. Same money, different timeline, completely different life outcome. Part 5. Inflation, the silent killer. Now let's address the elephant in the room, inflation. If inflation averages 3% per year, your $10,000 annual withdrawal today won't feel like $10,000 in 10 years. It'll feel closer to $7,400 in today's purchasing power. Here's what most people don't realize. Inflation quietly reduces the emotional impact of passive income. So your target number isn't static, it's moving constantly. Part 6. What $250,000 is actually perfect for. Now, I'm not here to depress you. $250,000 invested is powerful, just not in the way Instagram sells it. Here's what it's incredible for: covering your rent, paying your groceries, funding international travel, reducing work from 5 days to 3, giving you negotiation power at your job. It's not quit forever money. It's an I don't tolerate nonsense anymore money. And psychologically, that's massive. Studies in behavioral finance show that financial security reduces stress far more than extreme wealth increases happiness. The freedom from desperation is what changes your posture in life. Part 8. The objection. Now you might be thinking, so what's the point? $250,000 isn't enough. Wrong. It's a milestone, and milestones matter, because the first $250,000 is statistically the hardest. Why? Because compounding hasn't fully kicked in yet. If you're investing $1,000 per month at 7% annual returns, it takes about 14 years to reach $250,000. But going from $250,000 to $500,000, that might only take 8 to 9 years with the same contributions. Money accelerates. Early on, you push the snowball. Later, the snowball pushes itself. Part 8. A practical breakdown. Let's break this into 3 realistic portfolio scenarios. Conservative portfolio, bonds, dividend stocks, 4 to 5%. $250,000 times 4.5% equals $11,250 per year. Balanced portfolio, 60-40 stocks and bonds, 6 to 7% average, not guaranteed. $250,000 times 6.5% equals $16,250 average, not guaranteed. Aggressive portfolio, mostly equities, 8 to 10% long-term average, potential $20,000 to $25,000 average, but highly volatile. The higher the return, the more emotional resilience you need. This is where psychology beats math. Most people say they want aggressive returns. Very few can emotionally handle a 30% market drop without selling. Part 9. What you should actually do. Here are actionable steps. 1. Stop chasing the number. Define the income you want. 2. Multiply your desired annual income by 25, because 4% withdrawal implies roughly 25 annual expenses. 3. Invest consistently in low-cost index funds. 4. Increase contributions, not risk. 5. Let time do the heavy lifting. If you want $40,000 per year sustainably, you need around $1 million invested. Clear target, clear math, no fantasy. Part 10. The bigger perspective. Look, $250,000 isn't freedom, but it is power. It means you're ahead of most households. You have a cushion. You have leverage. You're no longer financially fragile. And here's the real mindset shift. Instead of asking, how fast can I retire?
Ask, how strong can I make my financial position? Because wealth isn't about escaping work, it's about removing fear. And $250,000 is the point where fear starts shrinking. If you're on your way to $250,000, keep going. If you've passed it, don't stop. If you're nowhere near it, start. Because the first dollar invested is more important than dreaming about $1 million. Build. Be patient. Let compounding do what it has done for centuries. And remember, money doesn't change your life when you hit a number. It changes your life when the income replaces your stress. If this helped you see the number differently, hit subscribe. I break down wealth building without the hype, just math, psychology, and strategy. I'll see you in the next one.